Hey traders, this is Christian from Hertz Tribeca Trade Group, and this is your end of day, end of week, and maybe we'll even call it end of month video. So today is the 31st, and a lot of carnage in terms of equities. I'm looking at a TLT chart. You're going to hear me talk a lot about bonds and just some of the moves. These were really impressive moves that picked up towards the end of the week in both longer dated bonds, short dated bonds. So I'll talk about what basically I saw there and some of the ETFs as well. We were talking about this at the end of the day, or I was putting out some notes, and I'll actually try to bring these up a little bit, just what I was referencing at the end of the day. But besides the morning pullback that when we came in the morning, obviously things had gapped down. We did get a little bit of a bounce, so I was playing the bounce a bit. But after that, I just kind of backed away. There's too many things that were falling apart, and so these were some of the things that I put out on the subscriber feed. Which I try my best to really help in these times. I've been through these times a lot. I was an institutional trader through. I started my career back in all the way back when the tech bubble happened, and then I really did a lot of my institutional trading when we had the financial crisis back in way back in 2007 to 2009, and traded through those times, traded ETFs. So, really, one of my expertise is kind of trading through bouts of volatility. So, it's always the same playbook, and sometimes it's one of the hardest things to do when things break down is to kind of just get out of the way. Unless you're really good playing things to the short side, and if you've caught things, if you've managed to kind of get ahead of the curve and play things to the downside, that flexibility really helps in a market like this. But if you didn't, and that's fine. I put on very small short trades. Did that a little bit yesterday in the room. I'm going to reference yesterday's video, not to say that I called things or anything like that, because I don't do that. But I think some of the things that I mentioned in yesterday's video were just basically saying, hey, we got to get through today. Now, that was, of course, before the tweet about tariffs in Mexico. So, I didn't have that information in front of me, but I just figured that not much was really going to happen in terms of today, in terms of Friday, right? So, I think next month, now, of course, there's a change in tone, but I do think next month will be somewhat different, and I do think that some traders were away for this week. This is kind of a holiday week, so we'll see what the first of the month brings. Right, that'll be on Monday. But yeah, that picture changed significantly from when I started yesterday's video. So let's talk a little bit about what to start with. Let's talk about the performance today. I've been showing this because I just want to start here to say that nothing has really changed. Nothing has really given you the green light to add risk into this. I've talked about kind of the checklist for the week several times. I've referenced this, and I'll probably have the same type of checklist because we didn't get any of these things. I said the support levels. Well, the support levels broke. So I'm going to go over that in the indices. So that did not happen. Institutions, the second one that I had on the checklist this is from last weekend's newsletter, was institutions need to stop selling and actually buy the dip. We did not see that at all. I will go through that. And here's where I talk about the percentage change from the open. So here's the percentage change from the open. Again, this is not percentage overall for the day, but this helps to see, and I'm sorry, this is small on my screen, so I'll just kind of explain what this is again. But I think this is really important to look at because it'll tell you what areas of the market buyers are coming into. And the top of the list, right? SPY actually fell down from the open. Q's the same. Dow did the same thing. TLT again was the only thing. Bonds were the one. So again, we're seeing this migration which was continued and heightened today as it was heightened yesterday with the move into bonds. And I'll get into whether or not it's run its course and if it's stretched or too dramatic. But we are seeing just continuation of move out of equities, out of high yield bonds, out of senior notes. I'll bring up that chart in a second too. Um, and so move out of equities and a move into bonds and all kinds of treasuries. Also, gold finally got a bid today. Gold miners, so here's the thing with gold, right? And I'm going to be a little bit tainted here with gold because we did look at the gold charts in the very beginning of the day in the pre-market session. I did not buy anything in gold. It had moved so much. So I think GDX was up about 4% for the day, but it made a move of 1.65 from the open. If you weren't smart enough to know that Trump was going to tweet something on the close yesterday, I'm being sarcastic, of course. That there really wasn't much gained in the overall gold mining section. So I don't think you missed too much. I mean, you have to ask yourself if this move in gold is going to continue. To me, I don't know. I just really don't like playing along with the. So I'm going to get into how I feel, but I'm not, going in because there's headlines. I'm just not trading that way. I'm not this herky jerky trading on headlines. I have never traded like that in my career, and I'm not about to start now. So I would rather sit on the sidelines, day trade, scalp until this kind of dies down a little bit. I don't know if it dies down, but I'm not going to be completely trading on. I'm not a high frequency trader, so I'm not going to be trading on headlines. Interesting. XOP actually finished marginally higher from the open. I mean, crude, which I'll get to as well. So a lot of things to get to. Utilities actually got a little bit of a bounce today. The Chinese internet's actually finished up. Sorry, looks like a child is doing this. What finished lower, which I did not like today, was biotech, semis. So again, just really didn't give you much to say, oh, here's a divergence. Here's something different than what we saw yesterday. So until I see that, I would rather not put money at risk. The FANG stocks, they all basically went down except for Google actually went up a little bit higher from, geez, this is horrible writing. Actually, it went up 8 basis points from the open, so congratulations if you went long there. But it looks like, again, I'm being sarcastic. But all the FANG stocks went down further from the open. Netflix actually caught a bid, but then went lower. So, out of all the things that I mentioned, what do I want to talk about first? Let's go to the month performance. You could see that this is basically, so this is a 1 year performance, and I went over this yesterday too, but I still think it makes a lot of sense to go over. TLT is the not the candlestick, but the white line, and the yellow line is equities. So this is basically just inverse. Right, so I mean, I don't think it takes a rocket scientist to figure out what happened here in the month of May. Just money completely flowed out of equities and went into bonds. You could see again the white line here, but again, complete opposite. Look at where the month started. Right, this is SPY at the high upper left of the chart and down to the lower right. Bonds lower left and upper right. So this, I think, really just kind of just sums up the month, right? And what was the performance of these? It's pretty amazing when you have something like this take place, that it was almost the exact opposite. 1 month, bonds were up 5.5%. And where did we finish here in SPY? Let's do 5. So that was plus 5.5%. It did not give me the same screen, so let me just switch screens on Bloomberg. Just about the same. Bonds actually did more, rallied higher than SPY sold off. So plus 5.5% versus minus 5. So if you managed to go short SPY and long bonds, you made over 10% this month. That's pretty incredible. between the comparison to the two. So the next question is this going to reverse for the month of June? Well, I mean, you go back to the kind of the cause of this, and unfortunately, I hate to say that headlines have caused this, but I mean, you would have to think it's partly due to, if not the majority of it, due to trade wars. And so let's look at the TLT chart. There's a couple things that I wanted to point out as we talked about yesterday. I did say my prediction yesterday was that we would see these taken out, this virgin point of control. But it was, I was thinking it would be like China PMI data. It wasn't. But nevertheless, this one in TLT was taken out. It was also taken out in bonds. Now there are higher levels to watch, but this is a pretty decent one that was taken out, and we're overbought. I mean, this is 72 RSI. Again, anything over a 70 is generally on the RSI is overbought. This is an 80, just almost an 82 RSI on TLT. So where, when has this gotten overbought like this? Back in December. Back in December, this happened, and it got overbought, came off overbought levels. So it could do this. I mean, I think that this is very extreme in TLT, but it could also burn off those overbought levels, so can kind of come in off of this. But I think for now, I mean, I think people are just as, the tweets that we're seeing are dramatic. I think people are really dramatic moving out of equities right now and just grasping for anything, risk off. So what else to talk about, or did I want to talk about? Let's talk about what the conclusion that I made around lunchtime, and of course yesterday as well, that I was looking for some type of divergence, right? So anyway, there are levels further up. There's another one up here in TLT, so this still could get taken out. This is at 132.88, which is another dollar up. Do I think it gets taken out on Monday, or do I think I think it's a higher probability that we back and fill, and then maybe take that out? But man, we are really cooking in these. Also, if you look at IEF, there's another one up here as well, right? So when you start to look at different things, I thought, if we're looking for a little bit of comic relief, this is the SHY ETF. This is 1 to 3 years. I own this. I own a big chunk of this. In just my regular personal account, just so it's not, because there's no bank money market accounts anymore, unless you can find a bank that actually has money market accounts. But I know, for instance, Chase, for example, they don't have savings accounts anymore. They don't have money markets accounts anymore. So your cash just kind of sits and doesn't earn any interest. So what do? I put my cash and I put it into something like this, SHY. And I was joking around in the trading room saying, do I need to take a target in this thing? Generally it really shouldn't move like this. But for the week, up from, up decently for today and for the week. So again, virgin point of control taken out here. So I did not take a target in my cash holdings, which is pretty crazy when you think about it. But again, look at the volume, right? So these are things that people will run into, and you could see the volume, which I wanted to point out today. People are running into these types of things. Look at this one. So this is senior bank senior loans. Look at this could be record volume. I do have the outflow up from yesterday, and so you could see, remember with ETFs, it's much different than stocks. You could see money being moved in and out via market making processes, create inflows and outflows. So you don't have to wait to 13F filings. You could literally see it. Bloomberg publishes it the next day. I put it out on Twitter every day because I think it's interesting that you could see the amount of money that was actually bought and sold. But yeah, I mean, this had a pretty decent outflow. Keep in mind, the size of this fund is huge. I think it's $4.7 billion. They had about a 300 million outflow on Thursday. Now, I'm sure they're going to have a much larger one from today, because I think this may have been the highest volume ever in the bank loan ETF. again, it's higher risk. It's known as high yield. With it's very different than HYG or J&K, but it is known as high yield, as Bloomberg classifies it. So, again, people are just running out of the door in terms of higher risk areas, and that's again, so that's the volume here, and this looks broken down, but nearly not as bad as this. What else? I talked a little bit yesterday about high yield credit spreads. Let's go ahead and look at credit spreads for the day. I haven't looked at this, and then I'll go back. I'm jumping back and forth through a few different concepts, but just stay with me. So if I want to look at IEI versus HYG for credit spreads. Yeah, I mean they're ticking up, right? As you would expect for the day. This is IEI versus HYG. Remember, this is where we were in December. So I've been referencing this a lot. Where we were in December. Are we having a similar move? I mean, it's getting that way, right? I mean, things are more and more leaning that way. Maybe we don't get that completely. So let me go through a couple other things that I think why I came to the conclusion that I was not seeing any divergence. Everything looked bad, which again does not tell me to really add any risk. It tells me to sit on my hands. Oil, big move down today and moving fast to the downside, breaking very quickly. So again, this was a great indicator back in October. I went over this multiple times now. That crude is a measure of risk off in higher times of volatility. Copper's moving down, right? So that also hit a low. So again, a lot of these things are all telling you the same thing. For me, again, the video is for information purposes only. I'm not giving any advice. But for me, it's telling me to stay out of the way, to get out of the way, basically, and let this move take place. The phrase that I put out last night, which is really cheesy, but I don't know, it works, right? The old saying, who was it, Schiller, who came up with this saying? I'm sorry, I'm butchering this. But markets can stay irrational longer than you can remain solvent. I think trade wars can go on longer than you can stay solvent. It's kind of a different spin on a similar concept, right? So, so I think you have to let this thing play out. So let me go through. So that's copper. Emerging markets, maybe a slight divergence here, up a little bit. How did they behave in October? They bottomed in October. They did bounce in October. Sorry, did I say that wrong? They bounced a bit in October, and then they came down. So this is a little bit of a bounce that's happening right now in the emerging markets. We'll see if that follows through anywhere. I don't think it's really taken out any upside levels. The level that I talked about in last week's video was 39.63. It held it, pretty interesting, right? So again, the weekly value areas will really give you those nice support and resistance levels. Let's shift over. So we talked about all these things that were moving down. The only divergence that I saw today, and I'm sure there's something that I'm missing, but if we go to the daily chart of the VIX, notice that this is not that heightened. You got to remember what the VIX measures. I think a lot of people on Twitter, no disrespect to anybody on Twitter, I'm on there, but I think a lot of people don't actually look up what the definition of the VIX is. All the VIX does is measured short-term volatility. So volatility in the SPX, that's it. In 30-day contracts, the implied volatility, if it's going up or if it's going down in 30-day contracts. So you could try to put other emphasis on the VIX, but that's what it does. It honestly does not do anything else. It's not broken. It just measures volatility in 30. Let me say it again in case I said it wrong. Volatility in 30-day SPX contracts. That's it. And right now, it's not showing nearly as much volatility when we in December. It's not showing that volatility in October, December, and it's not showing what it was in the for whatever reason. It's not taking out the May highs. So that is the only divergence. And again, it's not broken. It's not. There's nothing wrong with it. It's doing exactly what it should be doing. Measuring 30-day volatility in the SPX. Now you could look at some other things. You could look at the VXN if you think, this is the VIX for the Qs. You could look, and that's also showing the same thing. This is the VIX for IWM, which is also not showing any of that. So here's your divergence if you're trying to hang your hat on something, saying that this is different than what we saw in December. So that's not a lot to really go on. So let's go through. Next, I want to go through some levels in the S&P, the Qs, and IWM. I'll spend a couple minutes here in case you want to fast forward, in case you've heard me talk about this. But we've been talking about these levels for a good couple weeks, right? Since this started, we bounced on this. This is 28, 17, 25. I've talked about this multiple times, so I'll try to talk a little bit faster. But bottom line is we've fallen through this, and that's a no-no for me. So yeah, I think the VIX divergence is interesting, but this did not hold for me, and I've said it all along that I want to be less exposed to the market when this takes place. And unfortunately, we've now broken into the value area. We don't have to worry about. I spoke to my colleague Webb Begol, who designed this indicator. There is something called an 80% rule, but once it crosses once, then it's been fulfilled. The 80% rule being that once we start below value, break into value, establish ourselves, we could see an 80% probability that we go all the way through. So we did that from low to high. There is no 80% rule for the same value area, so you don't have to worry about that. The Qs, same thing. I was mentioning 176.19. I would be a buyer back above 176.19. So it is below there. So have to step away, I think. So again, that's my philosophy. You may disagree with that. You may think this is a good buying opportunity. You may not. You may be shorting like crazy. IWM is the one saving grace, believe it or not. It has not broken the value area. We talked about for the last couple of weeks how there was this consolidation and we could wind up down here. We also took out this Virgin point of control that I had mentioned in last night's video with both the upside one in TLT and the downside one in IWM. Both of those have been realized. So again, IWM is going to be a must watch for next week. That downside level has been realized and we've got very good support. So this I might be looking at for next week. Again, right now I think looks like it's catching a falling knife. So just keep in mind, cover up your P&L for the month of May. So I'm going to talk a little bit now about we could talk about performance for the week, because I do like to mention that very quickly. That's what we did for the week. I won't spend too much time there because I think I've already covered that. Also, looking at what performed, I talked about today's performance, but if you want to glance at as I'm going over, gold miners outperformed, solar outperformed, robotics still down but outperformed. The energy stocks are taking a complete whooping. What an amazing move some of these things have done in just a few weeks. And I think oil is down like 15 or 16% for the month. I'm ballparking that. That's not an exact number. So, so going forward for next week, strategy, right? What am I doing? So the only thing that I found in this analysis, which I've went over here in 20 minutes, is the only divergence that I saw that is showing some positive is that the VIX did not take out levels that we saw back in December or the beginning of the month. Everything else, copper, oil, a whole bunch of other bonds, right? All these things are showing risk off signs. Are they extreme? Yeah, I think TLT is very extreme. But I'll wait for a little bit of confirmation. I think part of the mistakes that people make is they think that they can time, or they know when these bouts of volatility are going to be over. The other thing is when you associate probability. Mr. Oddstats, I don't know who he is, but put out this: when the S&P falls 5% for the month of May, what happens for the rest of the year? So you have to associate a little bit of probabilities here, right? He's got, it looks like about 10 occasions where that's happened, and the majority of them, SPY or SPX finished positive. But there are some cases, you've got 3 cases where we continued lower. So there's no 100%. The reason why I'm going over this analysis is there's no 100% guarantee that things are going to be better. There's a good chance that this is a ridiculous move that we saw, but by no means is that 100%. So you have to weigh your probabilities. So does it mean that you can't take a shot on something? No, but how much do you want to? You have to ask yourself how much you want to risk. For me, again, I have a little bit of risk left. Took off a lot of my trades yesterday. I added a couple small ones today into today's weakness, but really I'm sitting with a really big cash balance because I will wait for some type of confirmation. Again, if you follow this type of reasoning, you're never going to catch the bottom. And all you have to do, and again, in this analysis, I'm not saying that we've got another one of these, but you could have said at any one of these, oh, this is too extreme, this is too extreme, this is too extreme. So, that was, if you took that approach, that was very painful in December. So I'm not taking that approach now. I will wait for some type of confirmation. And we've gotten nothing so far. So that's my view of just taking it easy. I think the other psychological factor is that when you have a loss on your hands for a week or for a month, your mind says, hey, I want to make it back right away. But it is just May. You've got the whole year to make it back. So my goal is not to make the issue worse. My goal is to let this market do what it wants to do to the downside, and then wait for when the institutional buyers will come back. Could that be next week? It could be the first of the month. Sometimes institutions do that. I think it'll be really interesting to see what happens on Monday when institutions come into the month. Are they going to go into bonds, further into bonds, or are they going to realize it's a buying opportunity, and maybe Trump diffuses the issue that he caused? So we don't know these. These are uncertainties. That's it for the for the weekend video. If you have any questions, you can email me. Again, my goal is to manage to make sure that you're not risking, that I'm not risking too much and letting this play out. All right, guys, have a great weekend, and I'll see you guys back on Monday. Again, any questions, you can email me, cfromhertz@tribecatrategroup.com. Thanks very much. Have a great weekend.